Hey everyone, and welcome back to the channel. If you've ever thought about investing but got overwhelmed by all the complicated charts, scary jargon, and the idea of having to pick the perfect stock, then this video is for you. What if I told you there's a simple, proven, and powerful way to start investing that doesn't require you to be a Wall Street genius? Today, we're diving deep into the world of index funds. By the end of this video, you'll understand what they are, why they're so effective, and how you can get started on your own investment journey. So what exactly is an index fund? To understand that, we first need to talk about a stock market index. Think of an index as a report card for a specific part of the stock market. For example, you've probably heard of the S&P 500. This is a famous index that tracks the performance of 500 of the largest publicly traded companies in the United States. We're talking about giants like Apple, Microsoft, Amazon, and Google. When you hear on the news that the market is up, they're often referring to how the S&P 500 performed that day. It's a snapshot, a benchmark, that tells us the overall health and direction of the big players in the US economy. There are thousands of other indexes too, like the Dow Jones Industrial Average, the Nasdaq 100, which focuses on tech companies, and even indexes that track international stocks or specific sectors like healthcare or energy. Now, here's where the magic happens. An index fund is a type of investment, like a mutual fund or an ETF, that aims to simply mirror the performance of a specific market index. Instead of trying to be clever and beat the market, an index fund's only job is to buy and hold all the stocks in the index it tracks, in the same proportions. So, an S&P 500 index fund will own shares in all 500 of those companies. If Apple makes up 7% of the S&P 500 index's value, then the index fund will also have about 7% of its money invested in Apple. It's a passive strategy. There's no star manager making brilliant risky bets. The fund just does one thing. It buys the entire market basket and holds on. This sounds almost too simple, right? Why wouldn't you want a brilliant fund manager trying to pick the winning stocks for you? Well, here's the big secret of the investing world. Most of them can't. Year after year, studies consistently show that the vast majority of actively managed funds, the ones with those highly paid managers, actually fail to beat their benchmark index over the long run. They might have a good year or two, but consistently outsmarting the entire market is incredibly difficult, if not impossible. Think about it. For every manager who thinks a stock is going to go up and buys it, there's another one who thinks it's going down and sells it. The collective wisdom of the entire market is a powerful force. This leads us to the first major benefit of index funds: diversification. When you buy a single share of an S&P 500 index fund, you're not just betting on one company. You're instantly spreading your investment across 500 different companies in dozens of different industries. So if one company has a bad quarter, it gets cushioned by the performance of the other 499. This is the classic rule of not putting all your eggs in one basket. It dramatically reduces your risk compared to trying to pick individual stocks. If the one or two stocks you picked go down, your whole investment suffers. With an index fund, you own a tiny slice of the entire economic pie. The second huge advantage is low cost. Remember those actively managed funds trying to beat the market? All that research, trading, and the high salaries of the managers cost money. These costs are passed on to you, the investor, in the form of something called an expense ratio. These fees can eat away at your returns over time, and they can be a significant drag on your portfolio's growth. Index funds, on the other hand, are incredibly cheap. Because they're just passively tracking an index, they don't need a big team of analysts. Their expense ratios are often a tiny fraction of what active funds charge. We're talking about as low as 0.03% for some index funds, compared to 1% or more for an active fund. That might not sound like a lot, but over decades, that difference in fees can translate into tens or even hundreds of thousands of dollars more in your pocket. Let's put that into a real-world perspective. Imagine you invest $10,000. Let's say the market returns an average of 8% per year. In an active fund with a 1% expense ratio, your real return is only 7%. In an index fund with a 0.04% expense ratio, Your return is 7.96%. After 30 years, that seemingly small difference is massive. The index fund investor could have over $60,000 more than the active fund investor just from saving on fees. Compounding works its magic on your returns, but it also works its magic on fees just in the wrong direction. By keeping costs low, you keep more of your money working for you. The third benefit is simplicity and peace of mind. Investing in index funds removes the emotional roller coaster of trying to time the market or pick individual winners. You don't have to worry about whether you should sell your tech stock because of a bad news report. You don't have to spend hours researching company balance sheets. Your strategy is simple. Buy a broad market index fund, keep buying it regularly, and hold it for the long term. This approach, often called set it and forget it, lets you harness the long-term growth of the economy without the stress and guesswork. The market will go up and down in the short term, that's a guarantee. But historically, over long periods, the overall trend has always been upward, driven by innovation, population growth, and productivity. By owning the whole market, you participate in that long-term growth. So how do you actually start? It's easier than ever. First, you'll need to open a brokerage account. There are many great low-cost online brokerages like Vanguard, Fidelity, or Charles Schwab. Opening an account is usually a quick online process. Once your account is open and funded, you can search for index funds. You'll often see them as mutual funds or more commonly these days as ETFs, which stands for Exchange Traded Fund. ETFs trade on the stock exchange just like individual stocks, which makes them very easy to buy and sell. When you're looking for an index fund, you'll see ticker symbols. For example, a very popular S&P 500 ETF is VOO, another is IVV, and another is SPY. You can simply type that ticker symbol into your brokerage's search bar, decide how much money you want to invest, and click buy. It's really that straightforward. You've just become a part owner in 500 of America's leading companies. You can also look for total stock market index funds like VTI, which give you exposure to not just 500 companies, but thousands of them, including small and mid-sized businesses. Or you can look for international index funds like VXUS to diversify your holdings across the entire globe. A great strategy for beginners is something called dollar cost averaging. This just means investing a fixed amount of money on a regular schedule, say $100 every month, regardless of what the market is doing. When the market is down, your fixed amount buys more shares. When the market is up, it buys fewer. This automates your investing and takes the emotion out of trying to buy the dip. It's a disciplined approach that ensures you're consistently building your position over time. To recap, index funds offer 3 incredible advantages. Instant diversification by owning a whole basket of stocks, incredibly low costs that maximize your long-term returns, and a simple stress-free strategy that allows you to benefit from the market's overall growth without needing to be an expert. Legendary investor Warren Buffett has repeatedly recommended low-cost S&P 500 index funds for the majority of investors, saying it's the strategy that makes the most sense practically all of the time. So, if you've been sitting on the sidelines, nervous about where to start, I hope this has shown you a clear and accessible path forward. Investing isn't about getting rich quick. It's about building wealth steadily and patiently over time. And index funds are one of the most powerful tools you can use to achieve your financial goals. Whether that's saving for retirement, a down payment on a house, or simply building a more secure future for yourself. Thank you so much for watching. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more content on personal finance and investing made simple. Let me know in the comments if you have any questions or if you're already an index fund investor. See you in the next video.